What's up, everybody? Michael Silva here. You are watching the Stock Market Brief Show. Ain't nobody want to buy the dip, so I just did. That's what we're going to be talking about in today's episode. It's wild, it's wacky, but I'll tell you how I'm navigating it. First and foremost, you saw this here on the thumbnail. This is pretty gnarly looking, and I'll explain why. I talked about it in yesterday's episode, but I didn't have the chart. We're looking here at a couple of indicators, and then we're looking at the New York Stock Exchange up top, okay? So the couple indicators that we're looking at is the NYSE Summation Index, which I like to show often, and the NYSE McClellan Oscillator, the 9-month traditional calculation. And what I'm pointing out here on the screen are these blue lines. These blue lines represent here when the summation index crosses down through zero. At about the same time the NYSE McClellan Oscillator gets a minus 300 reading, it has led to some intense volatility and or market crashes. Okay, so let's take a look here at the first line. Well, we saw a nice little pop-up, but then more volatility, and it didn't really do much. However, right here in late 2018, we got the same exact signal, and what took place? We got some extreme volatility and kerplunk. In 2020, the pandemic, we saw the signal right here and kerplunk. Actually, here in 2022, early 2022, we pointed this out where we got the 0 reading and a minus 300 reading. We were patient, very patient for it. It almost hit it right here. It actually got like a 295 reading. And then guess what? That actually marked a few days off from the top of the market. And as you've seen, obviously, we've seen some massive volatility and we're in bear market territory. Well, I'm showing you again because, well, one, the summation index has clicked over on its parabolic SAR right over here. Boom, boom, boom. And then we said, hey, this is where trends can change. The trend had changed. We're below zero. Okay, you can see we're below zero. We crossed through there recently, and we just recently got a minus 300 reading, minus 303.16 at about the same time. So is this giving us a signal that obviously more volatility is to come, and we're going to be wiping out these potential lows? It definitely means that we should be on guard. Buying the dip does sound quite stupid, but like I said, we'll talk more about that in today's episode. The Fed's balance sheet is reduction of the Fed balance sheet. As you can see, when this happens, volatility, increases, right? So as liquidity goes, out, I don't know how to do out, volatility goes up. And you can see the red line is the S&P 500 here. We pointed out this multiple times. Just volatility continues to just eat and swing and just go all crazy. If we take a look at some larger time frames, just to give you an idea as to where we are, this is something that we posted on Twitter a while ago. Right above 3,700 is the monthly lower expected move. Looks like we're in striking distance, to be quite honest. I'll go over the weekly expected move here momentarily, but this is one of the things that I posted on Twitter saying that, hey, don't rule this out. It's a strong possibility, and we're just about there. On the Qs, we're just about there too as well, the lower monthly expected move. And IWM, we're just there sitting on the weekly time frames. We still haven't touched the 200 weekly moving average on the SPX. You can see here, just by looking at the chart, just it looks like we'll eventually come touch into that region at some point. Perhaps, if we get a stronger move, we might be watching this lower trend line, and then we might get a bounce back up to this prior area of support. So that's, if we get a strong move, but there might be some intermediate term, bounces and, movement all through here. Like, perhaps we'd get something like that. I don't know. Let's keep continuing on. We'll get there when we get there, right? NASDAQ 100 looking pretty nasty on the week. We have one more trading day left. At the RSI pointing straight down. We still haven't touched with the 200 weekly moving average, but it does look like it's in striking distance. I don't have the IWM of this one, unfortunately. Let's take a look at the 10-year yield. So we talked about this one yesterday. Hey, is it backing off finally? Nope, didn't back off. It was up 5.64% on the day, closing at 3.7% on the 10-year yield. So these things, as soon as it broke this high, we are just firing off into the oblivion. Got to be careful here, right? Because we talked about bonds also. We said, hey, it's a potential flight to safety, we said. And you can see here we were down 2.55%. So yeah, despite the market being down, and you might think, okay, now our bond's going to act as the safety measure. Nope, not yet. We still have a positive divergence it's building on the PPO histogram, and this could still potentially turn over. This could be some shakeup, right, before we potentially get some sort of a pop. But as it stands right now, the trend still remains pretty much straight down. Also to note, the dollar had a shooting star type candle. Now it has a hanging man type candle. As this market continues to press self up, by market I mean the US dollar, you can see here, right, S&P 500 has been falling pretty significantly. And, we talked about this, like especially the rate at which the dollar moves. We talked about this bull flag and we said, hey, if it gets above this 20-period moving average in the Bollinger Band, why they were tightening up and we could break out, that can lead to some potential more downside. Well, as you can see, there was a little bit of a slight, it started moving up these 2 days and the market kept on moving up higher. So the correlation wasn't like 100% there. But as soon as we started getting momentum, just look at what happened to the S&P 500 there after as the dollar continued to move up. So if the dollar takes a breather here at some point, which by the way, this is really moving. I'll show you a larger chart. That will offer up some relief in my opinion, in the S&P 500. If you look at the monthly time frame for the dollar, look at the histogram on the price percent oscillator. You had the bullish crossover, which we discussed when it was taking place, and the dollar has literally gone, just about parabolic. That you can't get much more straight up than that. There's really nothing here in its way other than right up here where you get some prior price action, right in this range over here, 112.50 to 120, where you had this, swing low and then swing high. So this could be the bear camp that, hey, the dollar gets kind of like, locked up in and we kind of get some more volatility. But as it stands right now, RSI is burnt to a crisp, just keeps on moving. Remember, overbought can stay overbought for quite some time, as we've seen in prior various other charts using the RSI indicator. But yes, so let's continue on. I found this to be interesting. Copper typically moves with a high correlation to the S&P 500. So we're looking at a 30-day correlation, and you can see it's at 0.77 right now. So it's moving, almost one for one to the copper is moving one for one almost to the S&P 500 on a 30-day basis. And you can see here, this is where there's zero correlation at the zero line right here. And if we just go back through time, right, you can see that most of the time spent is at a positive correlation. And the reason why I'm pointing this out, as I have copper up top, and then the S&P 500 at the bottom, is because I wanted to highlight that, when we had this, bear flag that was formed, we said, hey, watch out for when it breaks down, that can bring the market down. Well, it did, okay? But I've noticed today that I found some very interesting positive and little divergences here. When copper puts in higher lows, so you can see little higher lows being built, but at the same time, S&P 500 put in lower lows, that actually played out to see some positive momentum in the S&P 500, as you see here, and then as you saw here. Are we going to see something potentially over here because it's forming once again right in this region? As you can see, S&P 500 has a lower low, and then the copper has a higher low. Is copper going to be taking out this? Copper's in a bearish trend, so likelihood that the trend continues to the downside. But as we've stated in multiple videos, and will again today, there is a possibility that obviously that this gets some sort of a relief move, but timing has been a little bit difficult. If we keep on continuing in, you can see here, this is the safety trade, right? Relative strength, looking at gold, utilities, consumer staples, bonds, defensive sector, it's an ETF, DEF, and then XLV as well. You can see that the majority of them are getting back above those 50-period moving averages and putting in higher highs and higher lows in the short term. Utilities has been one of the stronger ones. Gold is trying to get up there too as well. So from a rotation standpoint and a relative standpoint, safety trades are doing better than obviously various other asset classes, sectors, or industries. If we take a look at a couple of the BP charts, the RSI is now at 19.61 for the S&P 500. So it's getting pretty burnt up right here, and it's moving into a territory where it's pretty overextended to the downside. Doesn't mean that it can't continue, but be mindful that it is getting into a pretty extended reading. BP NDX, this thing, just a huge move, right? Just recently, right? We weren't oversold, but now we're back into that oversold condition, 27.25. We have a subtle positive divergence as we have a high to a lower high, a higher low, sorry. And then we have a low to a lower low over here. And it's also, look at this, it's readings, 14% of stocks based off point and figure charts are on buy signals. So yeah, they're getting completely and utterly obliterated, which we've seen, knee-jerk reactions from these type of levels, including if we were at last time we were at 15, was right over here, and then right over in this range right here too as well. If we keep continuing on, discretionary, right? We talked about this yesterday. We said most likely this is going to get sucked down into oversold conditions. Today it did, 28.92. Positive divergence is forming, as you can see, a higher low, lower low right there. Okay, it still looks, and it's coming into these overextended territory here just on the BP chart as well. You can see we can kind of chop around in this area, and it's pretty much pointing straight down, so it's likely to potentially head lower here. Just got to be very aware of that. And then also we have technology. It's at 23.68 on the RSI, and it still has a positive divergence. And look at this thing. We are getting 5.26 reading. Hello, alert, alert. That is a very, very low reading. Last time we were there was right here, which actually marked a temporary bottom where we started rallying, pretty much from that point. So we are getting very, very overextended, which tells me that, hey, tech could be a potential opportunity here. And if I look at tech today, on a red day pretty much across the board, take a look here at Microsoft. Microsoft held it together. Google held it together. Meta held it together, right? And Apple was down slightly. So the big tech, right, actually kind of held themselves somewhat all right, given the circumstances of the current market conditions. Now, if I take a look at growth versus value, this one still hasn't triggered above a positive rate of change. I would like to see a strong move, right? Because, the stronger the rate of change, the stronger the direction of the bounce could potentially be. But it's just there flirting at the 0 line. So I'm continuing to watch to see if that'll cross over. Why is this important? Well, the red lines on the screen, if you're new here, those indicate when the rate of change crossed down through the 0 line. And we were watching that very intently. If you can see, it crossed down through it right over here in this region. And that actually marked, well, a topping point in the Qs, right? Pretty interesting stuff. One last thing I want to go over is the NIAM, so asset managers and what are they doing, as far as real money. That's the right X down beneath. It's getting a pretty strong reading here. It's getting at 30. So I marked out the last couple of times it's been at 30. This one came close. It didn't quite reach 30. But I'll show you what happened here regardless. And then the asset managers were at a 29.59, which is also relatively a low reading. But back to over here, the right X, you can see the red lines, or the pink shaded areas I drew lines on. Right here, and right here, and right here. You can see that they're marking short-term bottoms, potentially longer-term bottoms, but it marked it right here at the bottom of 2018. Not to say that we're at a bottom of the market by any means. Marked it at 2020. Right here, it caught it, and we saw a little bit move up before moving down. Right here didn't quite reach that minus 30 reading, and you can see it went up slightly, but then it just completely fell on its face. We're in a bear market now. We saw a big, strong move to the downside. And now we're getting a reading back here again. So we'll continue to watch this. I look at this when it updates on the weekly basis. Let's take a look at some 15-minute time frames. S&P 500 tagged its lower weekly expected move. And I actually posted out on Twitter on this candle right here, pretty much the exact time is when I actually entered in. I took I was 100% cash yesterday if you follow. If you follow, I was in 100% cash. All right. And note also on the prior trading day, I made 125 basis points in the portfolio. So I was like, okay, I kind of want some long exposure. How am I going to play this? Besides obviously trading intraday, right? So I said, I'm just going to go ahead and buy the S&P 500 down here, and I'll just do 30%, right? So and that'll give me enough diversification. That's quite a decent sized position, I guess, right? 70% cash, 30% here. And I was like, all right, what does a 4% stop loss look like? Well, on the daily time frame, actually, I'll just show you on just the weekly time frame, I guess. What does a 4% stop look like from where I entered in pretty much at the low today? Well, it would take out this low and go slightly under it to be minus 4%. On a 30% position, what do I lose? If you know how to do the math there really quick, right? So I would lose 125 basis points on a 30% position if I go down 4% from where I got it. So I just said, yeah, I'm just going to go ahead and buy this specific dip and see how it plays out. But be mindful that if I don't recommend that really unless if you really understand position sizing, because a lot of people would look at that and be like, oh my gosh, you're buying the dip, it's going to go lower. I don't care if it goes lower because it's all on a relative basis here on my portfolio. It's all volatility adjusted. That's why there's 30%. If it goes down 4% from here, people will be like, oh, you were way wrong. I would lose 1.25% of my portfolio, and that does not include me intraday trading and also taking other various swing positions. So I just figured, why not just add in a little little bit here for a potential swing, and then I'll be watching for these potential levels to come into. These are the anchored VWAPs. The 5-day moving average, we're still declining, right? So the bears have, they have the strength right here. The CPI anchored VWAP still below that, and then even the anchored VWAP to the FOMC announcement, we're still below that too as well. Today was a boring day, but it was also quite volatile, right? As we caught it here, we saw a nice big move up, trick some people, and then we flush it right into closing about at the low of the day. So in my opinion, like, this does not look good. What I've seen in the past, which I kind of noted, around this range too in the Patreon, I said I wouldn't be shocked to see it flirt around the lower weekly expected move all day, or potentially even for the remainder of the week. So be aware of that. We've been seeing 2 sigma moves outside of these weekly risk ranges. When I looked at what the options market was pricing in at the end of the day for tomorrow, it's pricing in about a $5 move, and that's plus or minus. So what does that mean? It means that, take a look, if we start breaking down, start looking at 370 as the level to watch. Okay, that is an important level to watch going into tomorrow's trading session. If you are trying to, buy a dip, or you're shorting into this, and you're wondering potentially where you might go to, 370 would be an excellent level to watch. Qs on the 15-minute time frame did not hit the lower weekly expected move. It looks like it's honestly in striking distance. So, maybe we can hit it. We'll see. Bears have the momentum. Obviously, we're below those anchored VWAPs and below the 5-day moving average. IWM closed outside of the weekly risk range, so we'll see here if this starts catching a little bit of a bid to come back up right into it. Interestingly enough, Bitcoin had a pretty positive day today. I'll go over into the daily time frame here soon, but we do have a bullish crossover here on the Saylor to Schiff tool. It hasn't closed the week at this level yet, but if it does, then we need the next week, we need the following week to get above the high of this current week, and that would actually activate a buy signal for the price of Bitcoin, which sounds a little bit freaky to think about going long Bitcoin right here. If you look at the daily time frame, I mean, it looks like absolute crud, but it was up 4.96 when I pulled this screenshot while the whole market was down. Ethereum also was up 6.66%. Uh-oh, that's not good when I pulled the screenshot right there. But you can just see it's been taking a big hit to the downside from around 1800 down to around 1250. So what? So we're going to get a potential little relief bounce up into, back into 1500, back potentially to 1700 range. Come on, it's always a possibility here, and we got to at least be aware of that. You can see as it came to 1250, look at this level. Well, it was also prior resistance. Sorry, let me undo that. Prior resistance, boom, boom, boom. And then we exploded outside of it, and now we're just back testing it, and we're seeing a little bit of strength. So if this gives way, that opens the door for 1,000 and potentially lower. If we take a look at the zones, the downside is getting more muted and the upside is growing. S&P 500, yesterday was about a 7% upside to the upper range. Now it's 8%, right? The trend is still down, right? And it's, kind of bearish. And then the VIX, you have 6.65% upside to 14% downside. So the low end of that is at 23.28. So if you see the VIX come down into those ranges, be aware of that. This is my swing trader platform. If you click the link in the description, you can do the $9 a month, or actually, honestly, I would just wait till the end of the month, because if you do it right now, you have to pay. Patreon is weird. Patreon charges, anytime that you get in. So it's $9 a month, and they'll tell you at checkout that you're charged on the first of every month. So if you do this now, you'll get $9 now, and then $9 at the first of the month. But in this, you'll get weekly expected moves. You'll get these zones daily printed, which I'm not going to be showing those all, much more. I'm going to be showing this next, this Buddy Carter indicator here momentarily. I got that coded for Thinkorswim. I'm going to share with everybody. And then I get my watch list, trade ideas, expected moves for about 40 products and so forth. But yeah, it's $9 a month, or annually, it's $90 one time. So these are the predicted ranges. I've been working on getting this kind of set up, and then a couple extra elements on it for the watch list. And I finally got it all together. For the most part, it's almost all done. I just need to finish the video on it, and I'm going to share this with the Patreon group. This is just taking Buddy Carter's old formula around ATR, which is average true range, right? So historical volatility. I like looking at historical volatility and implied volatility, but what this does is it forward shoots out a range, and so you can see here the range going into tomorrow based off of, historical volatility is basically showing right here. You can screenshot this if you'd like, but 370.12 for the low end, 378.32 for the high end. And you can see here, price is, it comes outside of it. It goes, beneath it, above it. It tagged it perfectly today on the lower end, but you can see it projects it out and it actually tracks it fairly well overall, which is kind of nice because it gives you some levels based off of historic volatility that could be good potential levels to enter into or exit. So for example, here we're in a bearish trend. So hey, maybe 378.32 would be an area that if we get some sort of a bounce, right, that might be a good area to potentially short into if we get that level tomorrow, right? Just a thought. There's all kinds of ways that you can use this or integrate it, but yeah, I'm just sharing that with you. I'll also share the Qs. The Qs currently also, the range right here, you can just screenshot it. I'll hold it up here for another second, and then the IWM too as well. Right here is the ranges, 169.18, 173 to the upside. Go ahead and screenshot it if you want to take a look. That's all I got for you, everybody, on today's video. Have a wonderful day.